Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Spencer Cole. He's the Chief Investment Officer of Vox Royalty, which is a mineral resource royalty and streaming investor. It's an absolutely fascinating discussion coming up right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
What is a mining royalty investment?
It's a good question, Toby. So a mining royalty investment really is an income stream over future production from a certain mine. Typically, they come about when a certain prospector discovers a certain gold deposit, but they don't have $200 million to actually build the mine themselves. So the bigger mining company will buy that new discovery for a small amount of cash up front. Then they'll give them a mining royalty contract that says that prospector gets 1 or 2% of all the future revenue from that potential mine. So, and then that royalty stream, that is a contract that can then be on-sold to an investment company such as Vox.
I see a lot of mining companies, particularly that list in Australia, though often that is all that they have, that single royalty stream, and it's a farm in or farm out or some sort of arrangement that they have. How do you find these opportunities?
Sure. So we apply, I guess you could call it a big data approach to finding these royalties. So over the last 10 years, we've been constructing the world's largest proprietary database of mining royalties. And so we use that to sort of screen for mining royalties around the world. And often we're able to find them in the most unlikely of places. So for example, we bought one gold royalty from an automotive company. We bought another iron ore royalty from a telecommunications company. So, we often try and target unconventional holders of these mining royalty contracts because obviously just, they're non-core for that person or that company, and, we can acquire them for deep value.
How does an auto company or a telco come to get a royalty like that?
So typically those types of companies used to be listed mining explorers, and they may have sold out of certain mining properties that have subsequently gone on to be spectacularly successful from an exploration and development perspective. And so those companies are then hollowed out as listed shells. And then when a new company, call it a telco or a hearing aid company, which was another one we did a royalty deal with, when that new management team comes in, they drop in a new business. It turns out that listed company still holds this really interesting mining royalty. So we get into this interesting situation, Toby, where we knock on their door and we say, we're here to buy that mining royalty you hold. And often these management teams say, we don't own a mining royalty, we're a hearing aid company. And so it's a weird negotiation where we have to convince the company that they actually own this asset before we make them an offer.
So how is it that you know that they have the royalty and the company doesn't know?
Yeah, I mean, no fault to the management teams that I was sort of referencing earlier. Often when you acquire a shell company, there's only so much due diligence you can do. In one of the cases, one of those companies actually said to us, they said, thank God, this is a surprise on the upside. Most of the surprises with this shell company have been liabilities that we missed. So it's, a lot of these royalty contracts, they aren't centrally documented. They're often just a geologist puts them in the bottom drawer, and then, 10 years later, when the mines actually come into production, it's only sort of obsessive groups like us that have built this big database and combed through decades worth of data who actually can trace this royalty through. So it's no fault of those management teams, I should say.
So how are you tracking it down? Is there do you need to go to the some sort of government department and look at the tenements or something like that? How does that work?
Yeah, so we start with our proprietary database, and so we'll see in the database actually, I'll give you a worked example. So September last year, we acquired a royalty on a gold mine in Western Australia. We initially got intelligence from our colleague in Perth that this certain mining company that's based in Canada was applying for new mining concessions or mining leases over this large area of land. So we went into our database and to identify, were there any historical royalties over those new mining areas? And then we verified that against the government mining database. And so sure enough, we saw a 1992 legacy sort of forgotten royalty. And then within a space of 2 weeks, we were able to acquire that royalty. And then within sort of 3 months, that royalty area was being mined. So we're cross-checking against our own database with also various sort of government mining databases as well.
You're the CIO of Vox Royalty, which is a really interesting play on this thing, because you don't have the investment of a traditional miner, but you have some of the advantage of the upside of the, so if any of those commodities start to run, you'll do quite well. So what's the history of royalty investing, and how do you find yourself in this position?
Sure. So it's a niche industry, Toby, that has sort of grown on steroids over the past 20 years. Some of the first royalty deals ever done were back in the mid-1980s. The most famous royalty deal in history was actually a company called Franco-Nevada that really, they're the grandfathers of the whole industry. In 1986, they saw a small ad in a local newspaper in Elko in Nevada that a salty old prospector was selling a gold royalty, and they ended up buying that royalty for $2 million. Now, fast forward to today, that was in 1986. That royalty that they bought for $2 million has generated over $1 billion of revenue to them, and the net present value of the future royalty revenue is still north of $1 billion. So from that $2 million investment from that salty prospector, that's become one of the world's largest gold mines. They've mined in excess of 50 million ounces of gold. So I guess that sort of shows you the leverage that you can get when you make the right investments in mining royalties. And since that fateful investment in 1986, the industry sort of really caught fire about 20 years ago. And so in the last 20 years, it's gone from basically a $2 billion industry that had basically 4 or 5 players to today, it's a $70 billion industry with 30 listed mining royalty investment companies. So it's been the best way to play commodities across any asset class compared to mining companies, indices, equity indices, or actually the physical metal itself. Royalty companies have outperformed all of those commodity-linked benchmarks for the last 20 years.
Why do you think that is?
So I think part of the key reason is that a royalty and by extension, a royalty investment company gives you all of the upside that a mining company gives you. So exploration success, when you find the new Bonanza gold deposit, production increase. So when they increase production, therefore revenue, also price upside. So as commodity prices run, particularly in like an inflation environment that we find ourselves in today, royalties give you all of that upside. But importantly, you've got capped downside, because with a royalty, your first investment in is your last dollar in. So you're not exposed to operating costs, capital cost overruns when you're building a mine, which often happens. So you've got none of that downside that mining companies typically have, and all of the upside that mining companies offer you. So I think it's that asymmetric leverage that royalty companies that causes them to outperform.
What's your background, Spencer?
So I'm a mining engineer and I say a reformed investment banker. Those days are, no offense to investment bankers listening in, but they're behind me. And about 6 years ago, I co-founded a business called Mineral Royalties Online. And we sort of developed the world's largest proprietary royalty database and then vended that into Vox Royalty. So I teamed up with the Vox team about 3 years ago. And since then, we've led the entire royalty industry in terms of our growth. We've done more deals than any other company in our $70 billion industry.
So you developed some expertise in finding these royalties globally, created a database of these opportunities, and then that database has been vended into Vox, where you're now the CIO. And so you've got a pretty good idea where everything is around the world, where to look for them at least.
Yeah, absolutely, Toby. And it's one part of it is where to look. The other part is actually how to get in front of some of these salty old prospectors. We deal with prospectors all the time that this may shock you to hear, but some of them don't even have an email address. Some of
like
these
you bastards.
Well, yeah, exactly. So for example, recently, 2 months ago, we did a deal with some cattle ranchers in Nevada. A family that held this fantastic gold royalty, and these aren't individuals that you can just go to the phone book and look up. So one part is sort of identifying the royalty in a database, and then the second part is having agents on boots on the ground that can sort of augment that by getting in front of people in sort of off the beaten path areas.
So when you find an opportunity, how do you value an opportunity? How do you validate it? What's your process?
Sure. So a lot of the core of what we do in terms of due diligence is really technically informed. So our team at Vox has two mining engineers and 2 geologists. Statistically, mining is a very difficult business to make money in. Most discoveries are never built into mines. And most mines that are built, historically lose money. So to actually identify a new discovery and say, yes, this has the key, the secret sauce to be a profitable mine, statistically, it's very difficult. So that all starts with technical evaluation of the deposit, the geology, the engineering. Can you actually extract the rock at an economic level? The country and the community. Is this community supportive of a new mine? And will this government, be true to their word around the fiscal regime? And then, once we've done technical due diligence and sort of fiscal or economic due diligence, then we have our general counsel does, legal due diligence, because ultimately we're not buying mines, we're buying contracts that are sort of derivatives of mines. So we need to be damn sure that the piece of paper we're buying is fully enforceable in the event that things go awry.
So for the most part, these aren't operating mines. These are just deposits. And so you have to make an assessment about the viability of the deposit and the other things that you've just mentioned then. And you're providing some money which does go towards development, or that's simply to buy the royalty stream, and then you need to find a partner, or there's an operating partner, or how does that work?
Yeah, so that's an important question. There's 2 ways that royalties are typically created in the mining industry. One is, as I described before, the prospector is rewarded for their discovery and they get a free royalty for selling out of the early stage discovery. The other way, which we call origination, is as a form of project finance. So if you're a mining company that's building a mine, and let's say you're tapped out on equity and you're pre-revenue, so you can't put a lot of leverage against the project, you might sell a new royalty to finance that last bit in the capital stack, where if you need 10 mil, 20 mil, just to get the mine into production, you can sell a new royalty over that mine. We've back tested, over 40 years of royalty deals and over 600 separate transactions. And historically, the royalty deals with the most alpha or outperformance have been buying existing royalties from the likes of prospectors and explorers. So we're firmly focused on that part of the equation. So we're not funding the construction of new mines. We're essentially creating a liquidity event for prospectors and explorers, who need to rebalance their own wealth and their own portfolio to other areas.
Do you have a preference for the underlying metal or commodity?
So we have 51 royalty investments that are all around the globe. We're 70% weighted towards precious metals, and particularly gold, and then to a lesser extent silver and the platinum group metals. The other 30% of our portfolio is sort of opportunistically weighted across the commodity spectrum. So we have exposure to about 20 different metals, and those 30% sort of non-precious metal investments, they're across, base metals that often have a linkage to the electrification thematics, such as, copper and nickel, and then, some lithium exposure as well. But yeah, it's sort of, we are a precious metal focused royalty company. And that's probably for two key reasons, Toby. One is, from a macro perspective, we really love the fundamentals of, for the gold price at the moment, particularly with inflation and how it is at the moment. But the other aspect, which is probably a less obvious aspect, is when you look at the technical risks of, say, a simple open pit gold mine versus a more complicated zinc or copper, or, a mine that needs a lot more, sort of has higher processing complexity. If you're making risk-based capital allocation decisions, you're going to go with the mine that has the lower risk, which is often, gold mines over other mines.
Let's talk about inflation a little bit, and then let's talk about that in the context of those precious metals. So what are your thoughts on inflation at the moment? Why do you think that inflation is likely to tick up? Because there has been a debate, an ongoing debate about this is transitory, it doesn't look like it's going to continue on, or this is the real thing and it's going to persist. Yeah,
it's an interesting question, and one that we sort of we discuss around the proverbial water cooler quite a bit. I guess, when we look at from a consumer perspective, whether you're looking at, lumber prices, used car sales, and the lack of availability in used cars, or a lot of sort of common consumer-based inflation indices and metrics, it seems hard to imagine that's going to unwind in a hurry. And certainly, when we look at the fiscal stimulus out of the US, and the fact that when you look at some of the core sort of economic growth metrics, it doesn't feel as if there's a an immediate end in sight to that wave of new money being pumped into the system. So we're not macroeconomists at the end of the day, so we don't have a crystal ball. But certainly, a lot of those simplistic metrics that hit the consumer in the face that we look at point to the fact that certainly in the medium term, precious metals are going to be pretty well supported.
So let's talk about precious metals specifically. So why gold has been that gold had that incredible run through to 2011 or so, and then it's been sideways and choppy since then. So why do you think now is a good time for gold?
Look, I think, gold has this sort of X factor to it. It's been the most explored for commodity. It's probably been the most coveted, physical substance on the planet's history. And so there is this sort of intangible X factor to it that, particularly obviously in when there's a flight to quality and when there's any sort of instability, whether it's China's sort of rumblings about what they're doing in the South China Sea, or if it's food and water shortages in parts of the Middle East, or floods in China, Germany, you name it. A lot of this sort of insecurity and people continuously come back to gold. And sure, we've seen a huge amount of I guess speculation around crypto and specifically Bitcoin. But I think when you think about large liquid stores of value that have historically been safe haven assets, gold has been the top of the list for decades. So to your point around the relative performance of the gold price, yes, it has traded sideways over the last, call it a couple of years. But still, I guess from our perspective, we have both leverage linked to the commodity price. So whether the gold price goes up or even if the gold price goes down, but importantly, we also have huge operating leverage. So, gold companies, as they make new discoveries and as they bring, exploration projects into production, we get the benefit of that across all of our 51 royalties. So, even if the gold price does come off 20%, we've got sort of a number of new royalty assets that are starting to cash flow. So some of that sort of potential, the downside in commodity prices or gold price is going to be well insulated and exceeded by some of the incremental royalties that are starting to cash flow for us.
No doubt you've got a preference for some performance out of gold, but do you need the gold price to sort of do anything to generate reasonable returns?
No, importantly, Toby, like we don't when we run sort of commodity price assumptions during due diligence, we'll never use sort of pie in the sky estimates. We price our deals on the basis of, mean reversion for pretty much every commodity that we look at. So we'll never buy a 10, 20-year investment on the basis of spot pricing. That's just the quickest way to book an impairment next quarter and make your auditors unhappy. So we use very conservative commodity price assumptions.
So it's not based on the existing spot price. You base it on what in the event that has spiked, you base it on where you expect it to sort of return to or its longer run average.
Yes, absolutely. So, we look at, say, consensus estimates around different commodity prices. So if you take the gold price, for example, I think spot's around 1,800 at the moment. Most commodity analysts expect that, long term it mean reverts to around 1,500, 1,550 thereabouts. So, when we're looking at new royalty investments, we invest in mines that are competitive from a cost perspective, well below even $1,500. Where recently, 4 months ago, we made an investment in a mine called Otto Bore, and that's the third lowest cost gold mine in Australia. It feeds another operation called Thunderbox. So, these are mines that will be cost competitive even if the gold price dropped by 30 or 40%.
And how do you think about valuation? Are you looking for some sort of yield? Is there a P ratio for the royalties? How does that work?
Sure. So it's a really interesting nuance between, say, mining companies and royalty companies. So most mining companies, depending on where you are in the commodity cycle, they'll trade at between, call it 5 to 8 times earnings generally. Royalty companies typically trade at anywhere from 30 to 50 times earnings, which, for some people, particularly generalist investors coming into the industry, they sort of sit there scratching their heads and say, why the hell would I pay, 40 times for this, for this royalty company? But, for all the reasons I mentioned before, and the fact that, a royalty company, say, take Franco-Nevada, it's a $28 billion royalty company. It's run by 30 people. So, the operating cost profile and the leverage you've got to future investments is just, this huge sort of operating leverage. But, moreover, like every time a new discovery is made, they get all that upside without a single extra dollar out the door. So, going back to your question, how do we value royalties and how are royalty companies valued? They're typically valued on like a price to cash flow or price to earnings multiple basis. And then also, the other metric that's commonly used is sort of price to NAV, because the other quirk about a lot of royalty companies is they'll trade at a substantial premium to their intrinsic net asset value. So if you run a discounted cash flow model of all of their key royalties, they'll trade at sometimes between 1.5 to 3 times that intrinsic value. often because there's just a lot of these mines just continue to expand over multi-decades.
It makes total sense because most of the royalty is falling through to the bottom line. It's open for you to reinvest it, whereas in a mining company that's being chewed up on the way through. So that makes total sense. I sort of meant more, how do you think about the actual royalty itself when you buy a royalty? Is there, I mean, what's the basis for making a valuation for something like that?
Yeah, sure. Sorry, apologies. My previous
no,
answer.
it's fascinating. It's fine. But I just for my own interest.
Yeah, sure. So within our 51 investments in our portfolio, we have 5 producing assets, and then we have a further 16 assets that are, I guess, development stage, which have some level of engineering study that has been done on them, and then the balance of the approximately 30 royalties are exploration stage royalties. So when we approach a new royalty, typically, we have a bias and a preference for something that has some level of engineering study done on it. So whether that's a pre-feasibility or a feasibility study, and then what we'll do is we'll apply, a discounted cash flow approach to it, but then we'll overlay a series of incremental risks on that. So we'll say, we'll run something like a risk tree, for example, and say, what are the 3 or 4 or 5 binary risk events that will determine the success of this mine or this project? And so, for example, what's the probability that this mine gets funded? What's the probability that the community approves the environmental licenses? What's the probability that the government tries to steal this mine? And then we'll use our team's experience and then occasionally bring in, third-party sort of subject matter experts to price those specific risk events so that what we're left with is a risk-adjusted return profile of cash flows that we expect from that royalty investment.
You've got this profile at the moment where you've got certain exposure to gold and the other metals. Is that intentional, or is that just it's opportunistic? You take what you can find at the time, and so that's possible that could evolve over time, or is that something that you're going to try to sustain that exposure to gold and so on as it is at the moment?
Yes, so it's something that is quite deliberate. So in our proprietary royalty database, we have almost 8,000 royalties in there, and so we can change our sort of targeted lens towards different commodity groups and different countries at will. The reality is, a large part of our sort of our overweighting towards gold is because, as I mentioned before, gold has been the most explored for commodity in history. And so every time a mining project is sold and a royalty is created, a lot of it's a function of how many of those projects have been sold. So out of our 8,000 royalties, the majority of those royalties are gold royalties, because that's the most sort of common project being explored for and sold for royalties. So part of it's just a function of how many gold royalties there are out there. But we are, as I said, we're precious metals weighted, but opportunistic outside of that. We have had some of our investors have come to us and said, hey, we see you've got some of these other royalties. We don't really like those commodities. So, we're not really investing in you for that exposure to some of these niche metals, like graphite, for example. So 3 months ago, we entered into a deal, a partnership deal, where we basically we are selling 2 of our non-core royalties. They're in graphite, and we're selling it to a smaller royalty company that is firmly focused on battery metals, so which graphite is a key component of. So that was an example where we rebalanced our portfolio away from graphite because we weren't really getting much value from the market for our graphite royalties, and we could see that the value is going to be unlocked by putting them into a much more nimble and a smaller royalty company.
When you think about the concentration that you have, not necessarily to the metal itself, but to individual royalties, how do you think about? I mean, what's the largest you'd be prepared to hold in your portfolio? As a proportion of your portfolio is what I mean.
Yeah, this point around concentration risk is a really interesting one, Toby, and it's something that we really sort of focus on quite acutely, because we've allocated about just over $30 million to create this $100 million of market value in our portfolio. Across that sort of 30 odd million that we've allocated, the ticket size has varied per investment. At the upper end, it's been sort of, call it 4 to 6 million, but the average deal size has been probably closer to between 250 and 750,000. And we've looked at a number of larger royalty deals that would be sort of 20 to 40 million dollar ticket sizes, but ultimately we never want to be overly exposed to one asset and one mining company. We've just seen too many times in the past where a certain mine has operational disruptions, or the certain mining company goes bankrupt, and all of a sudden, if all your eggs are over allocated to that basket, all of a sudden your portfolio returns are impacted. So the short answer to your question would be, I don't think we would ever allocate more than, call it, 50% or probably closer to 25% of our total portfolio size to one asset. So, if we found a spectacular royalty investment that was quite large, we'd be happy to break it up with one of our peers to ensure that, we're not overly exposed to that one asset.
I saw when you first contacted me, I saw you were Vox royalty and streaming, and I didn't initially think that was going to be a mining royalty. So what's the basis for the terms royalty and streaming? What's the difference between those two things?
Sure. So they're two different commodity investments, but quite I guess related cousins. A royalty is typically an upfront percentage of future revenue or profit. So you make a one-off investment to acquire the royalty, and then you sit back and you get checks, as production occurs. A metal stream is a different type of commodity linked investment. So with a metal stream, typically you'll pay a certain amount up front to acquire the stream, but then on an ongoing basis, you'll get paid a certain percentage of that metal being produced out of that mine, and then you'll also refund them a percentage of their operating costs. So what's very common is, for example, if you've got a copper mine that might produce, let's say, $100 million of copper a year, and then it produces $10 million of gold a year as sort of a byproduct metal. Often a company will come along and they'll say, I want to buy 50% of all the future gold that comes out of your copper mine. And so that company might buy the metal streaming contract for, say, $20 million today. And then with every ounce that's mined, they get 50% of all the ounces, and they might pay a pre-agreed percentage of operating costs. So 20% of their operating costs. So it's I guess, a related cousin to royalties, but the key difference is there's an ongoing sort of OPEX, reimbursement, whereas with royalties, your upfront investment is your last investment.
So what was the experience like going from being a startup, basically operating an online database, to being acquired by a listed company in the States? In Canada, rather.
Sure. So it was an interesting journey, to be perfectly frank. We were using that database as sort of, we were, I guess, market makers or creating a marketplace for mining royalties. And then, we've been approached by a number of different investment funds and principal investors to basically, acquire our business and our intellectual property. When we first met the Vox team back in sort of mid 2018, there was sort of an alignment of values and alignment of vision as to how, both the commodity and mining industries were evolving, and then also the implications that would have for the royalty industry. So, we saw the value of what we'd created in our intellectual property, and, we wanted to ensure that, we were basically unlocking the maximum amount of value out of that by choosing the right partner to vend that intellectual property into. And the Vox team, they're fun group of people, and we saw the world in it through similar sort of lens. But we started working together initially, sourcing opportunities, and then once we realized that we could work really well together, then we entered into an agreement to basically formally sort of vend in our intellectual property for equity. And importantly, my partner and I, Rian, we didn't want to take a single dollar off the table when we sold that intellectual property. We said we see the value of what this database and what within Vox can create, and so we said we only want to take equity, and moreover, we want to invest more into the IPO when we went public in May of last year.
The idea of the mining royalty database is really clever. How did you come up with that?
So it really stems back about sort of 10 odd years ago. My partner, Rian, who's a South African Australian exploration geologist, he and I actually first met at BHP, the world's largest mining company, when we were both working there. And we kept running into seeing forgotten royalties that, were basically value was being destroyed because people had forgotten about them, both at BHP and then at other mining companies as well. And as time and time again, we kept seeing these damn royalty agreements that people had forgotten about. In some cases, we saw multiple royalties where people were owed tens of millions of dollars and they didn't even realize it. So that sort of planted the seed of an idea to say, well, how many other companies or individuals out there have got these extremely valuable royalty contracts, but they've either forgotten about them, or they don't have a marketplace, or they don't know how to actually monetize them. So that planted the seeds of an idea for us to basically say, let's do a really wholesale global search to see how many of these royalties are out there. And so we reviewed like tens of thousands of public filings, using sort of OCR and sort of smart techniques. And then we also went to a number of different mining departments and private groups to aggregate terabytes worth of private exploration data, essentially looking for any free text reference to a mining royalty, and then geo-referencing it against the underlying mining claims that it covered. So it turned into a bit of an obsession, to be honest, Toby. And at times, when we were sort of sifting through physical like boxes of data in dusty storerooms, Rihanna and I would look at each other and say, what the hell are we doing here? But fast forward a couple of years on, and the value of what we've painstakingly built over 10 years is really unlocking value for our Vox shareholders.
So how does a investment banker miner come to develop those skills in optical OCR, optical character recognition?
Look, I guess I love learning new skills, and I'm quite a curious mind, and I've been fortunate to collaborate with a number of other startups, tech startups, and just seeing, I guess, stepping outside of the mining industry, which can be a little bit draconian at times, and you see how people are using, various forms of cutting edge technology to, create new solutions and unlock value, whether it's machine learning or, you name the technology, and then applying these even at a very basic level to the mining industry still is ripe for disruption. We just saw the value of that use case instantly. But yeah, a lot of it just comes back to just searching a lot of stuff on YouTube and Googling a lot of stuff, really.
Yeah, that's the best way to do it.
That's
so what's the future hold for Vox? What's the plan over the immediate term and the longer term plan?
Sure. So we currently have 51 royalties. The one important thing for us over the coming quarters is really just revenue growth. So when we went public May of last year, one criticism was, hey, Vox, you've only got one producing royalty. You've got all these earlier stage royalties, but I can't really get that excited for one producing royalty. And we said, well, hey, just listen, we're value hawks. And so we won't ever overpay for royalties, but where we consistently find the deepest value is royalties that are between 3 to 24 months away from first production. And so we said that from day one to our investors. And so even just in the last 12 months, we've gone from 1 producing royalty now to 5 producing royalties. And then we expect, we're on track to end next year north of 10 producing royalties, just with what we've got in the portfolio. So naturally, analysts expect our revenue to increase exponentially. And analysts have our top line revenues growing considerably over the coming quarters. So I think the key thing for us as Vox management in the next 12 to 18 months is just demonstrating that revenue growth and sort of delivering on what we've said we would to investors, particularly when we went public. Beyond that, I guess in the medium to long term, particularly as we start generating, considerable amounts of free cash flow, we're looking at the best way to return that to investors. So we have an ongoing buyback program that we're actively executing on. We will look at dividends. A number of our investors have asked us to consider a US listing, so that's something we're actively working on. And then, beyond that, we've got a number of options in front of us. Either we can become a huge dividend payer, or at a certain point in time, if one of our larger peers wants to acquire us, we serve at the behest of shareholders, and when we see a deal that truly values us fairly, we'd be open to it.
Spencer, it's a fascinating idea, really cleverly executed. If folks want to follow along with what you're doing or get in contact with you, how do they go about doing that?
Sure. So I recommend they go to our website, so voxroyalty.com, or if they want to email me directly, I may regret this, but Spencer@voxroyalty.com. We love hearing from shareholders, both current and prospective Vox shareholders. But yeah, our website has a lot of our key information on it, Toby.
Thank you very much, Spencer Cole, Vox Royalty.
Thanks, Toby.